Britain is rationalizing risk, the quiet end of free trade. When governments announce large packages of support for business, the public instinct is to read them as expression of confidence, stability, leadership, commitment to growth. But this instinct is wrong. In political economy, what matters is not what is funded, but what is guaranteed. Guarantees are never celebratory instruments. They are deployed only when uncertainty has crossed a threshold that private capital will not bear. Britain's recent expansion of government-backed finance through export guarantees, loan backstops, and tariff mitigation facilities is not a growth strategy. It is a risk absorption strategy, and risk absorption by state is the clearest indicator that a market system no longer trusts itself. This marks a decisive shift not merely in British economic policy, but in the global architecture of trade and capitalism itself. Guarantees as a signal of fragility. In a healthy market system, capital prices risk. Bank lend, Banks lend based on expected returns. Exporters hedge exposure through private insurance. Trade flows respond to price signalings, not political buffers. When this system functions, the state remains in the background. Regulator, not insurer. But when governments step forward to guarantee loans, exports, or revenues, they make an implicit admission risk has exceeded the tolerance of private actors. Britain's expansion of export finance and growth guarantees is therefore not evidence of strength, it is evidence of hesitation. And hesitation by insurers, by investors, and by firms themselves. The state is not leading growth, it is standing between the economy and a fall. This distinction matters. Growth policy creates new productive capacity. Guarantee policy preserves existing structures under stress. One builds power, the other one prevents collapse. The tariff cohesion, trade as a weapon. The most revealing element of Britain's policy shift is not the size of the guarantees, but their justification. Explicit references are made to firms affected by tariffs. This language would have been unthinkable 2 decades ago, when tariffs were framed as aberrations, temporary distortions in an otherwise liberal system. Today, tariffs are no longer anomalies, they're instruments of state power. Global trading system has moved from rule-based multilateralism to strategic fragmentation. States now use tariff, export controls, and industrial subsidies as tools of geopolitical competition. Supply chains are no longer optimized for efficiency alone, they are redesigned for resilience, loyalty, and political alignment. Britain's decision to pre-position financial buffers for tariff-affected firms is a tactical recognition of this reality. It signals that trade policy's risk is now structural, not cyclical. The era of neutral globalization is over. SMEs and the illusion of market access. Nowhere is this shift more visible than in the treatment of small and medium-sized enterprises. SMEs are often celebrated theoretically as the engines of innovation and employment. In practice, they are the most vulnerable layer of the economy, thinly capitalized, credit constrained, and highly exposed to volatility. When lenders require 70% government guarantees to extend credit to SMEs, the implication is not that banks are cruel. It is that risk return profile no longer justifies the exposure without public insurance. This is not entrepreneurial capitalism, it is survival capitalism. SMEs are not empowered to grow, they are being kept alive. Their continued existence on market condition, but on stale depends not on market confidence, but on states' willingness to underwrite losses. That is a fundamental transportation in the nature of enterprises. Britain's structure constraint services without industry. These developments expose a deeper structural weakness in the British economy. Britain is a service dominated system operated in a world that increasingly rewards Industrial capacity. Finance, law, consulting, and creative industries generate income, but they do not anchor supply chains. They do not absorb tariffs. They do not provide strategic redundancy. Industrial economies can reroute production, substitute inputs, and scale outputs under pressure. Service heavy economies cannot. They must instead ensure exposure, but they lack the material capacity to neutralize shocks. This is why Britain leans on guarantees while others leans on factories. This is not a failure of policy competence, but a consequence of economic composition. From free market to managed survival, the broader implication is unmistakable. Global capitalism is transitioning from a system of decentralized risk taking to one of centralized risk management. Markets no longer self organize under the assumption of peace, predictability, and openness. They operate under conditions of conflict, fragmentation, and strategic rivalry. In this environment, the state re enters not as a planner in the classical sense, but as an insurer of last resort. It doesn't allocate resources efficiently, it decides which failures are unacceptable. This is the new axis of power, not growth rates, not trade volumes, not control over guarantees. Those who can underwrite risk determine which farms survive, which sectors endure, which regions decline. The illusion of quiet continuity. Crucially, this transformation is occurring without overt ideological declarations. There is no announcement of the end of free trade, no formal abandonment of liberal doctrine. Instead, the system changes through instruments, not languages. Free trade persists theoretically while being functionally replaced by managed exposures. Markets remain in name, but their downside risk is increasingly socialized. Capitalism continues, but its losses are political decisions. The quietness is not accidental. Power that announces itself invites resistance. Power that operates through guarantees appears technocratic, neutral, and inevitable. Conclusion. Power has changed form. Britain's nationalization of risk is not a local anomaly. It is a case study in a global shift. The world is moving away from growth driven by confidence towards stability maintained by insurance. The state is no longer merely a referee of markets, it is their shock absorber. In such a world, power no longer lies with those who grow fastest, but with those who can absorb losses strongest. The ability to guarantee to stand behind failure is now more decisive than the ability to innovate. Free trade didn't collapse, it was replaced quietly. And in the new open system, survival is no longer a market outcome, it is a strictly political decision.